Hello, everyone. Thank you so much for coming for HIP Financial Group's quarterly market update. I do get a lot of enjoyment out of these. It's kind of fun to dissect what's going on in the markets. What does everyone, economist-wise, think is going to go on in the future? Uh, Today, I do want to start with just an initial thought. Uh, Fortunately, as I look at the different people on this call tonight, the majority of you are in a very fortunate position financially. And that position is you get to maintain the lifestyle you've enjoyed for most of your life throughout your retirement, which is decades long. That's an incredible accomplishment. You know, as we sit here today, and I'm going to show you in a few minutes, we're dealing with stocks at all-time highs. And now we have alternative to stocks, aka the bond market, yielding pretty high levels. Um, it's probably a good time to just take in where we are and take risk off the table for a few reasons. Sometimes you get caught up in markets going up and thinking they're going to continue to go up and things are going well and maybe greed comes in. But anytime you're dealing with stocks at all-time highs, an alternative is paying a high percentage, and you look at your financial plan and you see the budget that you can afford for the rest of your life, and you're like, well, that looks great to me. My investments look great. Even if we could think the market's going to continue to go great and the economy's doing okay, you know, taking some risk off the table for the what ifs that can happen in life is probably not a bad idea. So this is really coming from if you have that greed gene kind of kicking in and you're seeing maybe a little FOMO of you saw Bitcoin going crazy and Nvidia stock going crazy, put all that noise away. What everyone on this call and what I do is help people maintain a lifestyle that they would enjoy for the decades they have in retirement. That's the approach you want to have around investing. In saying that, let's go through our presentation. As always, I like to start with the US stock market. So what we're looking at here is a snapshot of the last 25 years. Now, you'll notice something rather striking, in my opinion, is a normal business cycle, a period where the market's going up and a recession is normally 6, 7 years. In the last 4 to 5 years, we've gone through two rather humongous cycles, which is rather incredible. First, starting with the COVID experience, where we had the fastest decline in history. Government prints trillions upon trillions of dollars, triggering inflation and the stock market going up at one of the fastest pace in history. And that all came to a head early in 2022, where we also had inflation roughly 9, 10, 11%. What normally happens in that particular situation, the government realizes they have to step in. And the main way they step in is raising interest rates. And when you raise interest rates, it typically sends a signal to Wall Street to say, look back at history. What happens when we raise rates? There's a good chance we might end in a recession. So Wall Street typically likes to act ahead of the game. And so markets went down before the economy did. So here we were in October after a 25% decline in the stock market. Everyone started to look around and realize unemployment's still low, our GDP is still okay, earnings are pretty good. It doesn't seem like a recession's around the corner. And once that fear kind of went away, markets went back to all-time highs, and that's kind of where we sit today. Now, one of the things I always like to go over with my clients is, this ratio here. This is more like what's called a multiple we have to pay to own stocks. So just to give you some idea, if there is not a lot of confidence in the market, everyone's fearful of what can happen, your multiple's typically in the low end. Historically, low end might be high single digits or, around 8, 9, 10, 11%, kind of where we were in the 2009, 2008 financial crisis. You could have bought stocks at a 10 times earnings. Obviously, a very good time coming out of there. Markets went up 400%. So typically, the lower the multiple, the better return you're going to have going forward. The higher the multiple, the highest we've seen in history, is the tech bubble of 2000, where we were trading at around 25 times earnings. That period between 2000 and 2010, stock markets made no money. So the higher multiple we have to pay, typically the more return we've already gotten in the rearview mirror and probably more muted returns going forward. So kind of going back to my initial thoughts, just a reminder, hey, yes, stocks have been good. That means investments look pretty good. That means everyone's financial plan looks pretty good, but probably a good time to take some profits, do a little bit of rebalancing. So to kind of further that point, as we kind of look at what's called the multiple over time, this is one of my favorite slides. The slide on the left will say, is all the talking heads on TV trying to tell you what's going to happen in the next 6 months or next year? Well, here we are, this big red diamond, and what we've seen when the multiple gets this high around 2021, we've seen a bunch of bad years, we've seen a bunch of good years. Any one year is relatively unpredictable. But on the right here, this is markets over time. So this is, all right, pick a time where we have a certain multiple. Let's say we're multiples 20. And what do the next 5-year rates of return look like? Now the range gets much narrower. So what do you see as the overall theme here on the right side? It's up and to the left. So hence going back to what I was saying before, if we can invest in a multiple of around 11, 12, 13, your rates of returns have been, looks like on average around 15%. Certainly as the multiple goes up, the rates of returns are a little bit more muted. Now, want to factor in a few different things. This is just US stocks. This is why we are diversified. This is why we have not only US stocks, but international stocks, emerging market stocks. To go back at history a little bit, since the 2008 financial crisis, this has been a beautiful story for US. International and emergings have struggled a little bit. Now, the period of time before that, kind of your 2000 to 2008 period, international and emerging did much better. US didn't do so well. The 90s, we look great. The 80s, they look better. So these things tend to go back and forth. So I don't want you to panic the whole world's going to fall off a cliff because US stocks are only a part of your portfolio. Now, another thing to break down stocks into smaller groups, there's what's called value stocks and what's called growth stocks. Catch up to it. But at this point now, it's kind of hard to say if it's worth, and I'm going to make up a number right now, 500 a share, 700 a share, 1,000 a share, because everyone doesn't know where artificial intelligence is going. Value stocks is a little bit more, tends to be a little bit more dividend payers, where you're trying to find a stock that you think is cheap relative to what it's trading at. I'm going to make up a complete example. Let's say we like ABC company and it's trading at $40 a share, and we think it should be trading at 50. That's an example of a value stock. Sometimes they go back and forth between one might be a little bit more expensive, meaning the market's favoring that type of stock, or the other. So on this chart here on the left, what you're seeing is a period of time where growth stocks have done very well and value stocks are cheap comparatively. Right now, I have a little bit more of a value tilt in my portfolio because of that fact. And that also correlates nicely to the interest rate environment we're going into. So this is comparing how growth stocks versus value stocks do over time. So what happens if our interest rates are 0 to 2%, 2 to 3, 3 to 4, so on and so forth? As you can tell, the higher interest rates are, and we're going into a higher interest rate environment, value stocks tend to do a little bit better than growth stocks. My main point with this slide is to have an understanding of, just because something's done well over the last 1, 3, 5, and 10 years, doesn't mean it will always do well. And in reality, most of the time, what's done well over the last 5, 10 years probably doesn't do well over the next 10 years. Things tend to regress back to a mean. This is one of my favorite slides. This is a pretty good indicator of where we think the economy is going. Now, normally one of these things might drag us down into recession. So as we go through here, kind of housing, vehicle sales, kind of business development, think of like research and development, and inventories. Now, what would kind of, let's say, freak me out a little bit is, as we look at residential and then we look at the housing market of 2008, we clearly were in a bubble and the bubble had burst. Now, they all of these are pretty close to the long-term average. And saying that, even if we have a downturn, like to use a rather rough or crude kind of example would be like if you fell out of a building. Well, if you fell out of the first floor and you fell out of the fifth floor, it's probably a really dramatic difference in what could happen to you. So if our numbers aren't crazy high in bubble world, then yes, we can go down, but it should be not nearly as painful as like a 2008 bubble bursting of the financial crisis or the 2000 bubble bursting of the technology world. So everything here is actually looking in pretty good shape in terms of the overall economy. Uh, this is one of the scarier slides that I go over, and it's a little bit like musical chairs, and we don't know when the music's going to stop. Now, it'll be interesting as the election come up, how much of our national debt is part of the equation. But as you can see on the left-hand side here, our 2024 budget, we have a $1.6 trillion shortfall. That's a really big number. And now our interest on our debt is costing us 2 to 3 times what it has over the last 10, 15 years. So we're now in the roughly 33 to 35 trillion dollars in debt. That interest payments we're making is substantially higher, and we're also growing that deficit at a fairly high pace. Um, so what does that mean? That means we have to borrow. We borrow from individuals, we borrow from institutions, we borrow from pensions from other countries. And for now, we're one of the healthiest economies. I'm sorry. In terms of the big economies, the more developed nations coming out of COVID, we really lapped the field in terms of how well our economy is doing versus our peers. China is struggling a little bit. Europe is certainly struggling. Japan, relative to the last 30 years, is actually doing pretty good, but really nothing compared to us. Our economy is a really a wonderful thing we have in this country. And it really differentiates us versus a lot of other countries. Of course, we have our things we can improve upon, but in terms of the economy, we're doing okay. And so when the economy is okay and you're growing, you can borrow. And especially when you're the reserve currency of the world, you can borrow a lot. So as of right now, we haven't truly felt the ramifications of our borrowing. But similar to an individual, when you keep swiping that credit card, eventually you kind of have to pay the piper. Um, so our national debt on top of Social Security kind of running dry within the next decade, the Medicare pool of money running dry within the next decade, we have some very hard um, realities we're going to have to face as a nation. Um, so in saying that, going back to what I originally said at the beginning of this conversation is, if we're looking at your financial plan and we have a winning hand, we certainly need a rate of return that's necessary, but we're probably heading into a time period where caution is a worthwhile path to go at this point. That doesn't mean put it all under the mattress, but if you're in a range where if we feel comfortable kind of maybe in a balanced approach, I look at a balanced approach anywhere between, let's say 60-65% stocks or 60-65% bonds. It might be a time to go a little bit more on the lower end of your range. One of the biggest bright spots and the biggest surprises to pretty much every economist out there is the fact that we've been able to stay out of a recession where a lot of other developed countries are pretty much heading into a recession. And one of the reasons for that is our employment situation. So if we went back just almost a couple of years ago, we had 12 million jobs posted, and we only had about 5-6 million unemployed people. That's never happened in history. That's an insane reality. Now, what's happened as our economy has tightened a little bit, People have gotten a little bit nervous. Interest rates are a little bit higher, so it's sapping some of people's free cash flow. You saw that 12 million get down to about 8.8. But again, those are jobs postings for the 6 million people looking for work. So we still have a really robust employment situation. Our unemployment is pretty much one of the lowest it's ever been in history, sub 4%. So the jobs number still looks great. The economy still looks really healthy. So this is certainly a bright spot where we stand today. Now, one beautiful reality, especially for people in retirement or close to retirement, is, in the last 15 years, if you thought stocks were expensive, you say, all right, well, crap, I'm going to go in a CD and make 1%. Well, that's not a good deal. Money markets are in zero, and maybe bonds are getting you 3%. Well, now we're in a very different interest rate environment. It's really tough if you're a borrower. This is brutal if you have to get a mortgage right now. But if you're a saver and you want to be conservative, now conservative stuff is paying a nice, healthy rate. So your average corporate bonds are paying in between 5 and 6%. We got money markets and CDs still paying between 5 and 6%. So as we sit here and say, stocks are trading north of a 20 times multiple, which is at expensive levels, you know what? I got a winning hand. I got enough money to last me through my retirement. And if I could park it somewhere and make 5%, that's not a bad deal. So just to kind of recap how kind of the bond market works, bonds make or lose money in one of two ways. So let's give an example. Let's say we buy a bond right now. That's a 10-year bond, and we pay $100 for it. Now, when that 10-year bond is now paying 5% interest. So you're locked in to get 5% interest over the course of the 10 years, and then you get your money back. Now, let's say interest rates around the world go down over the next couple years. So the best anyone can get in a bond is now 3%. But if you have one paying 5%, it's worth more money. So if you paid $100 for it, now maybe it's worth $105 or $108. So you collected your interest, plus you got some appreciation on the bonds. As the rest of the world's interest rates went down, yours is still paying 5% for the next 8 years. Yours is worth more money, so you got some appreciation. So that's conceptually how the bond market works. And no, so if we head into a recession or a slowdown, or inflation continues to come down at a nice pace, the government will probably lower rates. So if you're in a money market account, you don't get really much of a deal. Or if you're in, let's say, 3-month CDs that are constantly coming due, well, if it comes due and now rates are only 4, well, now your 3-month CD is going to get 4. And if 3 months later, now only eligible is 3%, you're going to get a 3%. This is probably not a bad time to extend duration. So if you go to a bank and you see the 3-month CD is paying 5% and a 18-month CD is only paying 4.5%, well, you might say, well, I want the 5, I don't want the 4.5. But if 3, 4, 5 months from now, as you go to reinvest that 3-month CD, instead of getting 5, it only offers you now 4. Well, it turned out then the longer duration bond probably had more value. So it's probably not a bad time to, again, extend duration, do a little bit more long-term things. This is just to recap what happened a couple of years ago, and I just gave you the examples. Interest rates went down. This is what the slide here is showing you, why so many conservative investors kind of took it on the chin when bond markets and interest rates went up a couple of years ago. So we had the fastest move up in interest rates really in history in 2022, where they took it from about 0 all the way to 5 and change. So what you got was this period here was a 13% decline in the bond market. Now, the declines in the history before that were down 2, down 2, down 1, and down 3. So pretty much nothing compared to what we felt in 2022. Now, what people sadly do is, oh, I touched my hand on the stove, I felt a lot of pain, I'm not going anywhere. Really, once that happened, it was the best time to own bonds maybe in 20 years. So you kind of want to go towards the fire when it comes to investing. Emotions make you want to run the other way, but whatever's really felt the most pain recently is probably one of the best places to go, probably looking at cheap valuations. So always something to keep in the back of your head. Now, as I was touching upon earlier, we're in a world where we always want to be diversified, having exposure to all different types of markets. So in the stock market world, we have typically US exposure, developed markets abroad, think of Europe and Japan, and then emerging markets, a lot of Southeast Asia, China, South America. So we just went through one of the longest stretches in history and biggest stretches in history of US outperformance. So we're trading now, again, 20, 21 times earnings, very expensive levels. International and emerging are about 30 to 40% cheaper than this. Things tend to regress back to a mean. So I wouldn't be surprised if the next part of the cycle, international starts outperforming US. And this kind of drives the point home. This is kind of showing you what's called the standard deviation, or just kind of looking how drastic things can be over time. So as we sit here today, we're at roughly 2 standard deviations away from kind of average. So what that means is, we're like in the 97, 98 percentile of international stocks being cheap compared to US stocks. Now, this is one of my favorite slides. I tend to go over with people, especially as they might get emotional if we're going into a downturn in the markets. Any one year really doesn't make a difference the asset class you're in besides cash, stocks, bonds, gold, real estate. Everything could feel pain in any one year. And 2022 was a great example of you felt pain in stocks and bonds at the same time. So it's kind of a double whammy. But every one of my clients is a long-term investor. So if we just look at a 5-year rolling periods, this is going back from 1950 through the end of last year, there's never been a 5-year period in history where if you were in a 50-50 portfolio, you had lost money. Long-term investing is much more about staying disciplined and calm more than anything else. Now, one of the slides that I don't normally go over, but I think it's important as we approach this election season. Sorry, let me just find that real quick. A lot of people, well, let me have a quick conversation and then I'll tie it into that. I get it. We start to form in kind of teams. I'm on the red team, on the blue team. If my team gets in, it's going to be glory. Everything's going to be great. Oh, if the other team get in, I'm going to sell. I'm going to leave. I'm going to flee the country. You have to realize McDonald's sells cheeseburgers, whether there's a Republican, a Democrat, a Green Party, it doesn't make a difference. Corporations are pretty resilient. They kind of figure out how to work no matter who's in office. So historically, under a complete Republican situation, stocks have averaged around 12%. And under a complete Democrat reality, meaning Democratic president, Senate, and House, it's been about 10%. Both are fantastic. Both I'll take, no problem. Under the economy or GDP, GDP's actually done slightly better under Democrats than under Republicans. But everyone thinks it's this A or F situation of if this person gets in, the economy's going to tank. I want to sell and get everything out. Again, the overarching theme I try and go over everyone is discipline. No matter who's in the White House, no matter what is the makeup in Congress, no matter if we're going through a scary time internationally, if there's war, the economy tends to find its way. So please don't make any drastic decisions or think the whole world's going to fall off, at least when it comes to markets and the economy, no matter who gets in. Just stay disciplined, and it's pretty much served you well over time. I always quote a a Fidelity study where they took a survey of all the people that did the best in their accounts. And the number one answer was they forgot they had the account. Markets do well over time. If you just stay calm and stay disciplined, you're normally in very good shape. And so kind of just finish where I started. This is a period of time where I am taking a little bit of risk off the table. This is a time where I don't think it's going to compensate you to be a little bit greedy, to take a little extra risk. This is a time, especially with conservative investments, paying you five and change, that, we'll take the winning hand and, not take any more risk than we have to. Naturally, I am always here. If you guys have any questions, you can always reach out to me and we can set up one-on-one meetings. But at this point, I'm happy to answer any questions you have. There's a chat box feature, and there's also a raise your hand feature if anyone has any questions. And one side note, on our website, you'll see on the top right a link for educational videos. So in the future, if you ever miss any of our videos, they're all posted there. There's some good ones on the different tax planning you can do, as well as Social Security. So feel free to go there at any time. Well, fantastic. Thank you so much for joining me tonight. I hope you have a wonderful night, and I'm sure I'll talk to you all soon.